I think it's come as a big surprise to the market. I think most of the houses were predicting some form of taper of anywhere between $10 to $15 billion. And certainly after the comments from the Fed in May, the market was on very much a taper alert. And we saw the negative reactions from especially the emerging markets in relation to the impact of Fed taper. So certainly the economic numbers that had been coming in, at least over the summer, seemed to be more positive. The market had been reacting to them fairly well. But it seems that in the last few weeks, some of the numbers that were starting to come in were a little bit softer, and I think the Fed has reacted to those. The interesting thing is, though, that over the summer people were buying regardless of tapering expectations because they thought that the economy was recovering. And now there are some voices that are questioning whether the economy and earnings are going to be as good and what exactly it was, apart from the move in long-term rates, that has convinced the Fed to defer tapering for the time being. Yes, I think in the immediate short term, the emerging markets will rally back. It's interesting if you look at the share prices of where they are right now compared to where they were on May 22nd when Mr. Bernanke talked about tapering. Most of the indices are actually flat. So the US equity market is flat to slightly higher. Markets in Hong Kong, Australia are pretty much flat, and Korea as well. But the markets that are still significantly down are the ones in the emerging markets. And if the tapering is not going to happen effectively, at least for now, effectively what it does, it buys these countries and these economies a little bit more time to put their house in order. I think the Fed is also cognizant of the fiscal debate that is going to be happening in the US next month. But I think the important point is that for the people who thought that the US economy and US fiscal and monetary policy is not important for emerging markets Asia, I think it's brought it very much back in focus, at least the events of the last few months have. Well, first of all, the trade deficit wasn't as wide as what the market was expecting. I think it came in around 980 billion yen. Market was going for somewhere around 1.1 trillion yen. I think that isn't the key driver of what is going on in dollar yen. I think the key driver of what there is the Bank of Japan balance sheet expansion and expectations of further QE from the BOJ. Now, I think that at the moment what is happening is that the yen has strengthened and yet the Nikkei has gone in the other direction. It'll be interesting to see whether that decorrelation actually continues. If it does, it's a new phase of the market from what we've been seeing over the last year or so, which has been very much driven by just the simple move in currency. So at the moment, I think dollar yen is looking a lot at what is going on with the balance sheets. Mr. Kuroda will be speaking later on this afternoon. It'll be interesting to see what it'll be interesting to hear what he's got to say in response to the announcement overnight from the Fed. I think Japan's economy isn't losing momentum, but I'm not really seeing any indications that there is an economic growth which is very much independent of whatever the BOJ is actually doing, or independent of the move in the currency. It's still a bit early to tell whether this whole experiment is going to work. Certainly, they've managed to move the Nikkei higher. Prices are starting to creep up in Japan. So there are some positive signs, but I think it's still too early to give the overall verdict on whether the policies have been successful completely or not.